Welcome to The Explainer. Today we're diving into what might be the ultimate financial showdown, a timeless ancient metal versus a revolutionary new kind of code.
For years, the conversation has been framed as this zero-sum battle. It's one or the other. But what if that's completely the wrong way to think about it? The data, especially from the last 17 years, well, it tells a much, much more interesting, and I think surprising, story. All right, so let's get right into it. To really understand what's going on here, we first have to break down the fundamental differences between our two contenders. So, in one corner, you've got gold. We're talking about the ultimate store of value for millennia, right? It's a physical anchor for entire nations. And in the other corner, you've got Bitcoin, this digital upstart really born from the ashes of the 2008 financial crisis. And it's built on something totally new, cryptographic absolute scarcity. Okay, so when it comes to sheer scale, there's just no contest. Gold is the undisputed heavyweight champion. We are talking about a $36 trillion pool of capital. It's held by central banks, by entire nations, and of course, investors all over the world. Now compare that to Bitcoin. Its market is, well, it's just so much smaller. And that huge difference in market depth, that's a massive reason why it behaves so differently. Think about it. $1 billion flowing into the gold market is like a ripple in the ocean. That same $1 billion flowing into Bitcoin, that can be a full-on tidal wave. Okay, but here's where it gets really interesting. How do these two assets actually react when the global economy is put to the test? Because, as you're about to see, they tell completely different stories. So, if you look at their shared history, it's pretty clear they almost never react to major crises the same way. Take 2013, fears of bank confiscations in Cyprus. Bitcoin goes through the roof. At the same time, just the hint of rising interest rates absolutely crushes gold. Then, fast forward to 2020. Both of them surged because of all the money printing, but Bitcoin's response, it was an order of magnitude bigger. And right now, they're both hitting new highs, but for totally different reasons. You've got ETFs driving Bitcoin and massive central bank buying driving gold. But smack in the middle of all this, something huge happened back in 2013, a real psychological shift. Yeah, for the first time ever, the market decided that a string of computer code was actually worth more than an ounce of a precious metal. Think about that. This wasn't just some number on a screen. It was a profound paradigm shift. This was the moment that digital upstart proved it could stand in the same ring as the ancient king. And believe me, it set the stage for the absolutely wild performance we were all about to witness. So let's get into the numbers. Let's see how this rivalry actually plays out, not just in terms of raw performance, but maybe more importantly, what kind of risk you have to take on to get those returns. And wow, the annual returns really paint a stark picture, don't they? Just look at 2017. Bitcoin returns over 1,300%, while gold, it posts a respectable 13%. But then look at the very next year, 2018. Bitcoin crashes 73%, while gold barely even moves. It's really a tale of two worlds, explosive high-variance growth versus this slow, steady, plodding appreciation. But, of course, those incredible Bitcoin returns, they come at a cost. And that cost is just extreme volatility. When you look at it on an annualized basis over the last decade, Bitcoin has been more than 4 times as volatile as gold. That's really the price of admission if you want a shot at that kind of performance. And that volatility, it shows up in these absolutely brutal cyclical crashes. We're not talking about small corrections here. We're talking about peak-to-trough drawdowns that have wiped out anywhere from 77 to a staggering 93% of the asset's value. Honestly, holding on through something like that requires nerves of steel. So that brings up a really good question. How can we measure the relative value without the distortion of, say, the US dollar, which is itself constantly being devalued? Well, it turns out there's a much better way. And that's where analysts use what's called the Bitcoin to gold ratio. It sounds complicated, but it's actually super simple, and it's a really powerful metric. All it does is tell you how many ounces of gold it takes to buy one single Bitcoin. See, by pricing Bitcoin in gold, you completely remove the US dollar from the equation. What you're left with is this pure signal of which asset the market is favoring over time. It's a direct head-to-head comparison of physical scarcity versus digital scarcity. And the journey of this ratio, it's the entire story in a nutshell. It started near zero, then it hit parity, 1-to-1 back in 2013. Then it went on this incredible run to a peak where one Bitcoin could buy you 37 ounces of gold. Today, it's kind of settled around 14. This chart right here, it shows nothing less than a monumental, unprecedented transfer of wealth into a brand new digital asset.
So after looking at all this data, we get to the crucial point, which is that initial framing, Bitcoin versus gold, it really starts to fall apart. The market, it turns out, isn't treating them like enemies at all.
And here's the kicker. Here's why. Their prices are largely independent of each other. We're talking a long-term correlation of just 6%. So when one zigs, the other often zags. And what does that make them? Incredibly powerful diversifiers for each other, not direct competitors. This realization has led some pretty sophisticated investors to what they call the barbell strategy. It's an alternative portfolio idea that, instead of trying to pick a winner, combines the unique strengths of both of these assets. So here's how it works. In this model, gold acts as the stable anchor, right? It's your low volatility safety cushion that preserves your capital when things go south. Bitcoin, on the other hand, it serves as the high-growth engine. It's the asymmetrical bet, which just means its potential upside is way, way bigger than its downside risk, and it's designed to amplify your wealth during periods of monetary expansion. And honestly, this is the ultimate takeaway. The data, it just overwhelmingly concludes that instead of picking one over the other, the most resilient strategy is to recognize that they are so much better together. So the question isn't which one wins. The real question is, how do you combine that physical resilience of gold with the digital asymmetry of Bitcoin to protect yourself against every kind of risk?